Coming up in today's show, stocks fall as yields swing back higher, an update on the Middle East conflict, inflation comes in hotter than expected again, weakening demand for treasuries, and we kick off Q3 earnings season. Hey, what's up guys? Welcome back to Click Capital. Hope you're all doing well. It was a bit of a bearish day on Wall Street. With stock indices coming off across the board, it was small caps that led the way down over 2%. I'll get into that more on the charts a bit later on. And once again, the new safety trade, mega cap tech held up the best. And we also saw a bit of strength in the healthcare stocks. However, once again, it was consumer staples and those food stocks getting hit hard again. But before we get into the CPI report, inflation and ripping bond yields, let me just give you a bit of an update on what's going on in the Middle East. The Israel-Hamas war, we've still got fighting going on over there. Israel is still striking within the Gaza Strip, taking out key targets, and they're surrounding the border with hundreds of thousands of troops and are ready at any moment now to go into the Gaza Strip and take physical control and get rid of the terrorist animals known as the Hamas militant group, who are Islamic extremists who have been committing unspeakable atrocities as we speak against innocent civilians, and Israel is determined to end them once and for all. But the biggest risk now is if this war spills out into a greater Middle East conflict, and that's what the US is trying to prevent happen. We don't want to see Hezbollah or any other Islamic militant groups come and attack Israel, as that could spill over into something involving Iran or even others like Syria, Lebanon, and that would get the price of oil spiking, which the Biden administration really doesn't want to see. But so far it's contained to the Gaza Strip with a little bit of fighting on the northern border coming out of Hezbollah, and obviously this is a fluid ongoing situation that we'll continue monitoring as a key risk in the markets at the moment. What did get the markets moving a little bit today was the latest consumer price index CPI report coming out of the States, higher than expected. In September, we were expecting a 3.6% year-over-year increase. Actually came in at 3.7%, and we actually saw a month-over-month increase of 0.4%, which is 4.8% annualized. And even though there are some downtrends continuing in a lot of the components, as we can see in this green line here, all items less food and energy are continuing their downtrend. Food, energy, and shelter are still ticking up, and we can see that in this chart here of year-over-year changes. Car insurance is up almost 19%, transport 9.1%, shelter 7.2%, food away from home 6%, and other things like hospital services and food all increasing well above target. And there's a look at the month-over-month increase. We can see that's the big increase in price we're all paying at the pump these last few months. Energy, commodities, electricity, hospital services, and shelter all increasing at very strong rates month over month, proving that inflation is sticky, is still hanging around. And with that price of crude and the potential for it to go a lot higher, we could indeed see a second wave higher inflation 70s style, as energy is the most volatile component of inflation. That's why we see inflation data often correlate pretty closely with the price of crude and energy. And so basically what this data means is that the Fed can't declare victory on inflation just yet and officially announce that they are on pause as much as they would like to be. And the scenario of higher for longer just keeps developing legs. And we can see that in Fed fund futures actually increasing the probability that the Fed will do another hike in December or January to almost 1 in 3. So whilst it's most likely the Fed is done, I mean, anything can happen. Oil could spike up, and we see further upticks in CPI over the next couple of months, and then the Fed will kind of be forced to do another hike. So the window is definitely open for another hike. The Fed's leaving it open, the market's leaving it open, and the market's saying it's going to be about June or July next year before the Fed can even think about cutting. And the Europeans know that as well, with the ECB saying an oil price shock could spur another rate hike. Like the Fed, they'd very much like to have reached their peak in rates and not risk demolishing their economies too much. However, get inflation back below 2% is the number one mandate, and that's going to be near impossible if oil keeps holding above $80 a barrel, and who knows, we could see $100 a barrel before Christmas as well. On top of hotter than expected inflation data, also adding upside pressure to yields, was weak demand in a Treasury bond auction today. So ever since they lifted the debt ceiling, Treasury sold over $1 trillion in bonds to keep the country paying its bills. And that huge amount of issuance is keeping strong upside pressure on yields, but also investors now are starting to really look at the huge amount of debt the US has. And that's why we saw weak demand in an auction of 30-year bonds today, with dealers having to take up more supply after investors shied away a bit on growing alarms that the explosion in the supply of US debt could overwhelm Wall Street. And we can see that in the price action of the 30-year government bond yield today, which finished yesterday at 4.7 but ripped right back up to 4.88 today, and a big reversal candle. And the bond market pretty much just saying not so fast. Same with the 10-year back to 469. And so this recent rally we've had may not be over, because in addition to sticky inflation, huge amount of issuance, we've also got a third and other big powerful force keeping upside pressure on yields, and that's the Fed with their quantitative tightening program, basically looking to reduce their balance sheet. So before COVID hit, it was around $4.5 trillion, and basically what they do is print a lot of fake money to buy treasury, municipal, and mortgage-backed bonds. And so they exploded their balance sheet to almost $9 trillion come early last year, and that helped further fuel the everything bubble. And of course inflation, which they tried to blame on COVID supply chain shocks, which no doubt helped inflation, but however the Fed's liquidity was the biggest driver of that inflation, in addition to government stimulus. And so in order to tackle inflation, they've gone from quantitative easing towards quantitative tightening. They just give these fancy names to try and confuse the public. But basically what they're doing is allowing all those bonds they purchased to mature and roll off their balance sheet. And that's a form of draining liquidity from the system. And they're doing that in order to try and cool inflation by pulling liquidity out of the system. And so even though we saw a bit of a bump up after the regional banking crisis and the Fed put will always be there, the trend for their balance sheet is now down, and they would like that to come a lot lower, because we're still more than $3 trillion above pre-pandemic levels. And so there's a look at what the Fed holds on their balance sheet. And as you can see, it's pretty much all treasuries and mortgage-backed securities. So by allowing those assets to mature and roll off, essentially cease to exist, that's keeping upside pressure on rates, because when they were buying them, it's simple supply and demand. When there's more buyers, that's going to help keep yields down. And that's what they wanted to do during COVID. They wanted to keep credit markets functioning and keep yields low. However, that's not the mandate now. The focus is now on inflation. And so they really don't have a lot of room to expand their balance sheet unless absolutely necessary. So all this with inflation, record issuance, quantitative tightening is going to keep the upside pressure on rates, even if the Fed doesn't hike the Fed funds rate again anyway. And so while things are okay now, the US can easily borrow and pay its bills. The problem is the long-term picture and its huge $1.5 trillion budget deficit and accelerating long-term federal debt. Because like Paul Krugman says, the US needs to hike taxes or slash social programs to rein in the soaring deficit, but it probably won't do either, because any politician trying to do that is going to have a hard time winning votes and getting backing from their corporate masters as well. The other thing that could help is if the economy grew a lot faster than expected, generating more tax receipts. However, that works the other way as well. If we got a recession, the US government tax receipts would go down while we still had that huge amount of debt, and that could really amplify the problem. And that's part of the reason why we've got a lot of billionaire investors like Leon Cooperman expecting very little from the market and only interested in individual stocks, and that's a sentiment I kind of share as well. I'm bearish on the market overall the next couple of years, 10 years. I think we're going to earn below average returns. However, that doesn't mean you can't find individual bargains out there, of which there are a few, especially in old economy stocks. And Leon goes on to say, ultimately, we will have a crisis in public sector finance, and the market is not discounting a crisis. Overall, I expect very little from the market. However, there's still plenty of bulls to be found out there, with them saying today marks the 1-year anniversary of a new bull market, when the S&P bottomed around 3,500 this time last year. It's up 22%. However, that's well below the average first year of a bull market, when stocks normally gain around 39%. And bullish analysts are saying if we can avoid a recession next year, then there's a good chance for more solid gains in 24. And I'd say that's a bit obvious, because it's a recession that will truly send stocks through the wood chipper. And of course, if economic growth and corporate earnings hold up, then that will help stocks. However, like I show you on this channel, there's a lot of strong indicators saying that we will get a recession within a year. Moving on, China's still scrambling to keep capital within their own country. There's a lot of wealthy people there trying to get their money out. That's prompted Beijing to ban brokers from opening overseas trading accounts for local investors. And that's because, much like most of the West who have dumped Chinese stocks over the last couple of years, international investor capital has been fleeing at record rates. Even domestic investors are shying away from their own equities and want to invest abroad. However, their own authoritarian government won't allow that. That's why we've got the China 50 index continually trading weak, and just taking you out to a weekly chart, it's now been in a multi-year bear market and well off its highs when their main index reached over 20,000 back in early 2021. And we're just starting to get into Q3 earnings, with the banks coming in tomorrow. Starting things off as usual, we've got JP Morgan, Wells and Citi, and some are saying higher rates are expected to lead to a jump in losses on banks' bond portfolios, contributing to funding pressures. And so we'll be looking for commentary from Jamie Dimon, CEO of JP Morgan, and what he has to say about the health of the US economy. And data from FactSet shows that for Q3, the estimated earnings decline for the S&P 500 is is 0.3%. And if that comes in as expected, that'll mark the fourth straight quarter of earnings declines reported by the index. And looking out to Q4, analysts are expecting a return to growth, with earnings expected to come in 9.3% higher year over year. So there's big expectations going into the rest of the year. And so it's possible the market might get excited with that, and that bullish Santa Claus seasonality could play out. However, stick with me because I'll look into that one on the charts a bit later on as well. We are already starting to get some earnings out, with one of the first big ones being Walgreens, a stock I've been interested in the last couple of weeks due to it getting really oversold. And we just got news of a new CEO coming in as well. And they just reported their latest quarter much in line, delivering 67 cents per share in earnings versus the estimate of 68.5%, and they beat slightly on the top line revenue as well. And the market seemed to like that, and along with the new CEO, shares finishing up over 7% today. And you guys will remember I first mentioned it to you on the 29th of September after we had that big move up to $22 a share. I'd mentioned it's really undervalued, and we had a bit of technical bullish divergences on my custom indicators as well. And so far so good. And just looking at my stock fair value indicator, I still think this has room to run, and I've currently got fair value more closer to around $51 a share. And the technicals looking good as well. We may have put in a bottom here. You can see industrial production and manufacturing in the United Kingdom is contracting month over month at some significant rates, -0.7 and -0.8, which annualized is over 8%. And over to the States, weekly initial jobless claims came in line as expected, 209,000, and there's those inflation rates. Month over month coming in a bit higher than expected, 0.4%, and year over year headline coming in a bit higher than expected as well. Coming out soon, we've got some inflation data from China, going into tomorrow, inflation data out of France, and then not too much to finish the week, just a consumer sentiment survey, which may come in a bit weak on the back of these higher energy prices we've all been paying. Fear and greed index is still not getting too excited here. Seems a bit muted lately, currently at 35, and corporate insiders are not very active in this market, both buying and selling at relatively low levels. And a little bit of a busy day in the options market for a Thursday, coming in at 40.5 million contracts traded, slightly higher amount of calls at 52%. And tomorrow's the end of the week, and just looking at max pain on the S&P 500 ETF SPY, that's at $430. So it finished today at $433.70. And basically what that means is if SPY finishes at $430 tomorrow, that'll make option dealers the most amount of money, because that will result in the most amount of option contracts expiring worthless. And that's something we've been seeing of late, and a general theme in market for years now, is what often happens, especially on Fridays, often results in near maximum profits for option dealers. And just looking at the daily chart of SPY, going off that theory, a likely scenario for tomorrow is we finish right around here, just above 430, and with the VIX likely crushing again, as it does just about every Friday, probably to just above 15. And that would be the most amount of benefit to option dealers if we saw VIX crush, premiums come down, and the SPY just finish slightly above 430. And looking out to next Friday, which is the third Friday of the month, when all regular monthly options expire, we've got the same max pain level in the SPY, $430 as well. However, that can change over the course of a week, so I'll let you know what it is this time next week as well. Getting into the charts, we can see all US indices turned lower today. Got the S&P 500 rejecting off the 50-day VWAP. We haven't quite filled this gap yet, but stick with me because I'll finish this video with my final thoughts on the S&P 500. But just looking over other indices, we saw the equal weight come off a bit today, down 1.2%. There's mega cap tech holding up the best, with the Nasdaq the only indice above its 50-day. That was only off 0.35% today, and the smaller we go, the harder we got hit. There's mid-caps down almost 2%. Small-cap Russell still in this strong short-term downtrend, down 2.2% today. And micro-caps getting whacked, down 2.5%, actually closing at their lowest level since mid-2020, over 3 years ago, just taking them out to a weekly chart. There's micro-caps really weak and breaking down to new lows. So the small end of the market is not doing well at all. Over to international stock indices, we got a bit of a turn lower as well. Canada's TSX, the UK FTSE still holding up pretty good. German DAX pinging off the 50-day. China was the loser of the bunch. The Nikkei turning, and same with the Aussie turning off its 50-day. There's breadth turning as well. 40% of stocks above their 20-day average, and that trend of the amount of stocks making new lows versus new highs continues to show high ratio, especially in the Nasdaq, 175 new lows today versus 30 new highs. But it's those magnificent 7 mega cap tech stocks really holding up the indices and the spreads we watch here. Looking at the growth versus defensive sector spread coming back up to year-to-date highs. Same with growth versus value stocks breaking out, and look at that rip in Nasdaq versus Russell, currently currently sitting at all-time highs in a strong short-term outtrend, so tech's really outperforming most of the market here. There's a chart of the spread between gold and treasuries in a strong short-term uptrend, and a place that investors could be flocking to for safety because we know bond prices have been getting the lights beaten out of them this year, and that could potentially add another further tailwind for gold as well. Inflation expectations ticking back up on the back of that CPI report, and even short-term bonds ticking back up as well, 2-year at 507, and that means more pain for TLT, falling 2.7% today, with bond prices just as volatile as stocks, and that bump up in yields has helped the dollar climb back up above 106 in a reversal candle, and keeping downward pressure on things like crypto and commodities pretty muted, although gold's holding on pretty well considering that move back up in the dollar today. And there's crude, just kind of trading really quietly in this support zone now, 83.30 a barrel. And I can imagine if we get down to the low 80s, down to $80 a barrel, that could be a good dip buy, even as a hedge, an asymmetrical bet, because it's hard to see the floor of oil dropping out anytime soon, with a lot of upside risk if the conflict in the Middle East does spill over, and that's going to keep upside pressure on inflation, downside pressure on stocks. So we'll continue to watch the situation over there and the price action in crude along with it. There's a look at agricultural commodities, looking to climb back up there 50, still in a medium-term uptrend, with things like orange juice still ripping up to all-time highs, and sugar as well sitting near highs. Over to stock sectors, and let's start off by getting a bit of a bird's eye view by looking at my sector trends table indicator, and we can see it's technology, communications, and semiconductors that are green in all time frames. So they're above all 5, 20, 50, and 200-day moving averages. Then we've got much the rest of the market with a lot of red, especially things like consumer staples, retail, the airlines, home builders, regional banks, and even the financials and healthcare still in dominant downtrends. There's one of the better performing sectors of late, cybersecurity pulling back a bit today, and semis coming back up to this big resistance zone, just taking you out to a weekly chart. That's where we topped out in late 2021. Looks like it may be coming up to test that again. And like I've been saying, tech is the new safety trade, which has pretty much been the case all year. Further weakness in clean energy, those climb back up in yields, really upset the home builder stocks today. The worst performing sector down 3.7%, and the weakness doesn't seem to be over for the airlines either, down 2.3%. Biotech actually breaking down to new multi-month lows. I would have thought REITs came off a bit harder with that jump back up in yields, but they still came off 1.3%. And defensive sectors, healthcare, consumer staples, and utilities all finishing lower. We also got BlackRock reporting earnings tomorrow. We'll be looking at that one, along with the big one, JP Morgan. There's a look at Apple, now trading back above its 50-day for the 4th consecutive day. Same with Microsoft and Google, all holding on really well. And NVDA drifting back up to near all-time highs, around $500 a share. And Tesla, the weakest of the pack, coming off 1.5% today. Was pretty weak across the meme space. We also had earnings coming out from Delta today. They came in with a slight beat on the bottom line. Market did a big bearish engulfing candle off 2.3%. There's the Birkenstock IPO from yesterday. Seen a lot of weakness in these IPOs. It came off 6.5% today. And the defense contractors kind of just holding ground there after their big gap up on Monday. Israel stocks finding new lows again. And there's snack maker Kraft Heinz, falling a huge 5% today after they got a downgrade from an analyst. And like a lot of these other snack makers, been in a strong downtrend these last couple of months. As some saying those new blockbuster weight loss drugs are a long-term headwind to these stocks. But even though when you look at the earnings like we got out of Pepsi a few days ago, they actually beat on the bottom line. These drugs don't look to be materially affecting their earnings right now. However, the market is a forward-looking pricing mechanism, and this stock too came off 2.7% today, with others as well like Mondelez falling almost 3% down to multi-month lows. Also got some weakness in the world's largest luxury goods maker, LVMH, which owns Louis Vuitton, along with dozens of other luxury goods brands, and we've been seeing some weakness in the top end of the market there. And this stock trades over on the Paris exchange, and the reason why I've added it to my watch list is I think it's starting to get cheap. My stock fair value indicator, given a fair value around 830 euros, and with a market cap of 343 billion, I think that is starting to get cheap for the world's largest luxury goods company, because they own businesses that are hundreds of years old, not just in fashion and makeup, but also in property and wine. And so I don't think they're going anywhere. And just looking at a weekly chart, if we get back down into this support zone, below 600 euro, I think that would make for a really good value and long-term bet for anybody that wanted to be a part owner of all these brands here. Just looking at some other stocks we're interested in. NextEra Energy came off a little bit today. Same with General Motors. And a bit of a turn down in Sphere Entertainment, down 6.3%. We'll be looking for support around $33.50 a share there. And the telecom's still weak as well, coming off a bit today. And we've got regional banks reporting over the next week and a half, along with the big guys over the next couple of days into early next week. And that could get things moving in the financial sector and market as a whole as well. Okay, over to the S&P 500, just looking at my custom indicators, dark pool percentage, currently in the neutral zone at 45%. Same with S&P 500 oscillator sitting right at 50. So the market's technically in the middle here. We may have completed this pullback. You could say this is a bit of a reversal candle here today. However, we didn't quite get that gap fill. And just looking at the S&P 500, the biggest overhead resistance zones, more around that 44.50 level, just taking you out to a weekly chart where we've had a few turns before at that kind of area where the market's pivoted. We did put in a weekly candle formation last week on the S&P 500 on this trend line, which did appear we get the bounce off that. However, we now touched the 50-day and breadth is still really weak. We've got yields climbing back up, bit of a tail risk in the oil market, inflation coming in hotter than expected, and now we're going into Q3 earnings. So any weakness out of the banks coming in lower than expected or weak guidance could get things turning back down, and other things if oil rip back up, yields rip back up, that's all heavy pressure on stocks. And like I just showed you, across sectors, most of the momentum is to the downside. So I'd say the odds are we're close to completing a short-term pullback here. We may fill this gap tomorrow or next week, but I'd really be looking for that 44.50 to come in as resistance. And then this trend line we've been watching could get tested again next week as well, and we may fall through it. That's all for today. Thanks for tuning in to Click Capital, and I hope to see you again tomorrow afternoon. Cheers.